My name is Tim Craighead. I'm the Global Chief Content Officer at Bloomberg Intelligence, and it is absolutely my pleasure today to welcome you all on another edition of Evenco's Trend Watch webinar series. This happens to be volume 27, actually, of these, where we've picked a topic that's important and timely in the marketplace and look to explore this with CIOs, investment strategists, asset allocators, etc. And in this instance, given the time of the year, coming back from summer holidays, looking towards the fourth quarter and on into next year, we've appropriately named this, late cycle long game. Where are C-suites, where are CIOs deploying capital now? And with us today, we've got, I think, a pretty august group of speakers to join and share some insights. We've got Stephan Kemper, who's the Chief Investment Strategist at BNP Paribas Wealth Management. Eric Lundqvist, who is the CIO and head of public market investment at Coeli. Maya Bandari, who's the Chief Investment Officer, multi-asset at Neuberger Berman for Europe, or EMEA. Sebastiano Piro, who's the CIO at Algebris Investments. And last but certainly not least, Joe Little, the Chief Strategist at HSBC Asset Management. So I don't think we could come up with a better group of experienced investors to share some thoughts with us. I would like to do a couple of things right up front, so bear with me. I'm going to share a screen. There we go. You've already seen this from the standpoint of who's on with me today, but let me give you a little perspective on what we're going to talk about. There are a couple of housekeeping things that we'll dispense with quite quickly, but to get into the crux of the discussion today, we want to think about what's happening from a macro vantage point with views from across these organizations, and then spend a lion's share of the time looking at allocation across asset class, across regions. And chances are we'll dive into other elements, whether it be thematic sectors, factors that'll come up over the course of our discussion. So I think that there's a lot to look forward to. Up front, this is a webinar that is organized by Evenco. And we appreciate the work on this. The core of the business revolves around fund forums that happen across Europe. There are still several left to go as we look into the fourth quarter, whether that be coming up next or later this week in Lake Como, or later on Dublin, Lisbon, Stockholm, and Paris. It still has the St. Andrews retreat that was last week that was a very good event. Notably as well, there's another area within Evenco Analytics, that has some pretty intriguing predictive fund flow data in terms of where funds are going in terms of assets. And there'll be a couple of reference points I'll bring up, setting the stage for some of the discussion that we have today. Bloomberg Intelligence, just to give an unabashed sort of little perspective, we are the investment research business within Bloomberg. There's almost 500 of us globally. We cover all markets. We cover industry sectors, equity and credit. And if you've got a Bloomberg, you've got us at your beck and call. Don't hesitate to IB us. I'm sure you've seen our research across the terminal, but there's almost 500 of us behind that research, and we'd love to engage. Without further ado, let's talk about the macro backdrop. And what I'd like to get into with our panelists is their perspective on the outlook. I'd set a stage by looking at a couple of points of reference. We all know that Trump tariffs have been a prime focus all year long, certainly, especially since April 1st. And where we're setting right now is about a 16%-ish effective tariff rate. That little chart up on the top right hand puts it into a little longer term perspective to show just how big these tariffs are. It's a reasonable question to ask. What does a 15-16% tax on doing business in the US do to your business? It's not just tariffs when it comes to policies in the US, though. There's also immigration, there's defense policies, energy policies, tax cuts, and importantly, looking ahead, a lot of regulatory change. Interesting to note that while there was a big economic forecast or economic growth consensus drop post the tariffs, that indeed things have slowly started to bubble back up in terms of consensus expectations for economic growth. And with that as a backdrop, I'd like to quiz the panelists on what is it that you all think from the standpoint of the macro backdrop? What's your assumption? Are you concerned? Or are you optimistic that the worst is behind as it relates to some of these exogenous impacts? Joe, how about we start with you, if that's okay?
Yeah, for sure, Tim. Thanks a lot. Happy to go first. So, I mean, what I would say is we see exactly like you've mentioned, a number of quite complex factors affecting the demand side and the supply side of the economy coming into play. But broadly, the pattern is one of a cooling down of US growth and a coming together of growth rates around Western economies. I think in the US, probably in the UK as well, the idea of stagflation light, by which I mean sticky inflation, goods inflation rising, services inflation being a bit sticky. That's a dominant feature. In fact, you might argue that the inflation target de facto, given how the data is behaving, is already at 3% for those economies, and that keeps Fed cuts relatively modest. We expect, but uncertainty is fading. Now, I think the bigger issue is as we look maybe slightly longer term into the future, we see what I call the G0 economy coming into view, which is a kind of a new paradigm, really, one where supply shocks are more dominant feature of the macro landscape. And the big question is how some of those demand and supply forces interact together. It might not take that much macro activity to generate a bit of inflation and sustain inflation at this point. And all the while, the G0 feature is economic power is shifting, transitioning to the global south, to Asia, to frontier emerging markets as well. So quite a complex set of forces coming together for investors. But I think the profound change has been the rise in importance of supply side factors.
No, fair enough. Who else wants to jump in on this one?
Well, I think from my perspective, and Joe was already referring to it to some degree, is that we have this narrowing growth gap with slower growth in the US and somewhat growth acceleration from very low levels, though, in Europe, driven by the expected fiscal impulses due to German infrastructure spending or generally more defense spending. I think those are probably the dominant forces from an economic perspective. And then indeed we do have the question, what can central banks do? And the Fed is indeed between probably a rock and a hard place. We have this slowdown in the labor market, which has been put forward as a reason for the first rate cut that we see just recently. But then on the other hand, this inflation topic is still there. Inflation is still very much alive and healthy, if you like. And we indeed do have the risk that the tariffs, which you showed, which haven't really fed through the system. That is at least our feeling. They haven't come to surface yet, but we are quite sure that they will. That is the question. Where will they show up, and with what sort of force? Will it be really just this one-off shock event like a tax increase, or will it probably more like a sneaky, more longer lasting thing? Because when you look at company data, when you look at certain company surveys, they are indeed saying, yes, we want to hike prices in order to pass on the costs, but at the same time, due to the overall economic situation, we may not be able to do it all at once, but slowly and surely, and this indeed could derail the market's optimism in terms of Fed cuts, and this in turn then would probably put the whole, say, AI optimism, especially the most recent leg upwards in long duration US tech assets, at question. So that's the way we take it right now.
That's good. I mean, there'll be plenty of those elements that we'll come back to. Maya, how about yourself?
Yeah, I mean, we have I guess, a slightly different tilt at Neuberger Berman, and I think there are perhaps three things to say in context of what Joe and Stephan have already said. I guess the first is that when we look at 2025 so far, asset markets have performed very differently to last year, and indeed, I think most people's expectations for this year. And in some ways, you could say it's been almost inverse. You know, areas like US equities that absolutely smashed it in 2024 have had in aggregate a softer year this year, and areas that had a soggier 2024, EFA equities, European equities, emerging markets, bonds have actually done much better. And as all our listeners will know, you know, under the hood, it's been even more nuanced. You know, as in the US, for example, as the broader market sort of grinds to fresh highs, that the median stock is actually down 8% or so from the peak. But you know, I guess at Neuberger Berman, there are areas where we're actually taking profits on some of these views, in particular, you know, around some of those long European trades that Stephan and Joe touched on. Because I think the second key thing to say is that you know, the macro backdrop has also turned out to be quite different to I think what we expected, especially around Liberation Day. And I think your chart earlier showed that. You know, I think on the positive side, the US is clearly weaker than we thought it would be in January. It's weaker than it was last year. But it's a whole lot better than we, frankly, at Neuberger, and I think most other places expected it to be around those the darker days of April, if you will. Similarly, inflation is higher, but it's nowhere near as sticky as feared. And I guess on the less positive side, and this sort of ties into the European picture, growth in European economies, growth in European earnings, the revision of those earnings has all been somewhat softer than we expected and than the consensus expected. And so, you know, being long of European equities, being long of the euro, was some of our sort of Liberation Day trades that we're actually stepping away from. And I guess just my third and final reflection would be that, you know, while trade has undeniably and understandably been a key factor in how we've all thought about markets, you know, there have been at least two or three other very important factors at play, you know, and we've touched on some of them already, but just to maybe flag what they are to us at Neuberger, I'd say first is this rotation away from monetary towards fiscal as a key, and in some cases, the key policy lever. That's, you know, you've got bloated fiscal balances as a percent of GDP and elevated debt in many countries, and this is putting pressure on longer term rates that matter for us all. The second is a more challenged setup for monetary policy, which of course really began in the aftermath of COVID and has extended ever since. And you know, when we look at, for example, the labor market in the US today, you know, we're at a kink where, you know, if you have any further falls in job openings, you could have a more meaningful rise in unemployment. And so, you know, we are looking for the Fed to certainly deliver what is priced. And of course, we've had plenty of geopolitical tensions to deal with, both within and between nations. So I throw some of those other factors out there has been pretty important for how we think about asset allocation more generally.
Oh, fair enough. And you mentioned a couple of fixed income related elements in Fed policy dynamics. Sebastiano, I know among other things, Algebris has got, a credit fixed income perspective, and you're closely associated with financials. How does this play, the macro backdrop, play into your work?
Well, I mean, financials over the last 3-4 years have behaved remarkably well, right? Because we had 10 years of very low or negative rates across Europe. That has forced companies, very simple, to cut costs to survive, to be able to survive. And then we had a huge margin expansion in 2022 with very sharp rate hikes, and that has increased basically the revenue base. And so margins have tripled. For the average European bank, margins have more than doubled over the past few years. So you can imagine, in this situation, in general, credit has done very well over the last 2 years, and financial credit has done even better. And financials in general have done super well. Today, from a fundamental standpoint, we have companies that operate in such a strong quality that ultimately, whether the outlook is for slight inflation or slight deflation or even a mild recession, in the end, it wouldn't affect materially the numbers because the numbers are so inflated versus the past, where from a credit perspective, I think financials, and today they are well recognized to be so, but generally financials look very, very strong going forward. So we have navigated this phase pretty well, but mainly because of the micro. The macro has been a mess. And I think for us, I summarize it. For us too, looking forward, these things, generally I would make one remark. Fixed income normally does not like large changes. But we had so many of these over the past 6 months where, I ultimately think that nobody feels particularly comfortable in giving you a 3 to 6 month outlook because it's quite difficult. We have tariffs by themselves. Think about this. In the US, we were thinking about hiking taxes, and the tax hike would have been something around 150 billion, and it would have been a disaster in terms of what was being discussed. Tariffs alone are 3 times the impact. So there has been a huge amount of tightening, even though the fiscal backdrop remains loose. We're talking about a 6 to 7% deficit. There has been some tightening, and this may show up in numbers. We may have, in fact, the economy is actually slowing. It's not accelerating. In Europe, we had remarkable performance. And think about the equity markets, they have done super well. But if you look at the numbers, actually, it's been all multiple expansion. There has been zero bottom-up improvement in the fundamentals. Hopefully, it happens next year. But see, we are approaching this phase in a rather stretched fashion, and this is across assets. So my hunch here would be, look, I don't see particular amount of risks, and I don't see them in financials specifically, but the reward side of things is quite skinny.
No, fair enough. And we'll come back to some of those elements as well. I want to shift, last but not least, to get a little perspective from Eric. But I want to set you up a little, Eric. You can think about what you want to add, if anything, on that macro backdrop. But an element that continues to, frankly, surprise us a bit is that even with this uncertain macro backdrop, what's happened with tariffs, other policy initiatives, war in a couple of different venues, we keep seeing profit margins rise. And this is specifically as it relates to the US and Europe. Part of the reason why markets are up is because profits are up. At the same time, we've also got the dollar that's dropping quite precipitously, which is part and parcel of the macro backdrop. So thinking about maybe those elements in addition to you all's macro vantage point, are profits sustainable with the backdrop and the outlook that we have? And what are you thinking about in terms of currency these days? And how does that play into your work? So long-winded question, but I'll lay it over to you.
When it comes to margins, we see that importers are paying some of the tariffs. Korean or Japanese car makers are lowering their prices quite substantially. And we've seen just in the Q2 numbers how the US profits, was actually better than expected. So we see some real growth there, but we did not do the same in Europe. And of course, that's one of the reasons why we see this risk for a recession in the US. And I also think that the market has put a lot of this behind it. I mean, just look at the contract when it comes to both tariffs and inflation, with quite a lot of volatility in those baskets. In the year, the first half of the year, but those are now, of course, it's quite a while. But my view of the world where we are right now is pain trade has been up in equities, and we've been something close to Goldilocks. And if we are going to see a recession in the US, we need to see it quite soon, right? So it's been better than expected, I would. Can we continue to see this? I mean, the longer we don't see the bad things happening, I would say that bigger chance is that we'll see it continue. And when it comes to if I guess the consensus is, has been said already, that the growth differentials in US versus the world increase. So that, of course, could continue to make the dollar weaker. But I guess one thing, that could change that is that we see that the US markets outperforms again, of course, when it comes to potential bubble candidates that will stop the dollar weakening at least for a while. You're on mute, Tim.
Thank you, Eric. Curious what if others want to jump in on the topic of currency, the idea of de-dollarization in the wake of what's going on with now Federal Reserve policy being in an easing mode. Depends on what your perspective is. U.S. economic growth being under some pressure. Is the dollar weakness cyclical, or is it more structural? Any takers on that one before we shift gears more towards asset allocation?
Yeah, I'm happy to jump in. Maybe just
Please.
Quickly though, before I do, just to echo, I think what Sebastiano and Eric said around European earnings. I think your chart showed profits expanding, but the growth of that expansion has, we're all expecting 10-11% growth, and it's zero at this point. So I think the delta is quite important. On the dollar, I mean, look, we've had, again, as your chart showed, Tim, a fairly sizable move, certainly in something like the euro dollar, where we've moved not far off parity to 117, 118. I mean, I don't think we'd be saying at Neuberger that the move is done and it's behind us. But we would say that a big chunk of that move, particularly on the euro dollar, has perhaps occurred. And that is as much driven by prospects for the euro to strengthen from here as it is for the dollar to weaken, right? Because currencies are always a relative play. And I think when we look at Europe, when we look at the macro setup, when we look at the political setup, we think it's going to be perhaps a little bit more challenging, certainly for the euro to rise much further, at least in the short term. You know, things like rate differentials, which have tended to be, for I think all of us in the room, as something that we've looked at in the past as giving a decent steer to currencies, has been pretty hopeless for this year. Whether you look at real differentials, nominal differentials, short end, long end, currencies have kind of done their own thing. But again, I'd say when we do look at some of those traditional relationships, you know, I think we'd say that there's more downside risk for European rates here. In other words, that the ECB, that's priced to do very little from here on, may need to cut a bit further, and things like that would underpin or would challenge, if you will, further euro strength. Now, again, I'd say there's some areas where we still think there is juice to that trade. So, for example, some of the emerging market currencies. I don't know if we want to come on to emerging markets at some point in this discussion, but you know, versus emerging markets, I think we do think there is still room for the dollar to weaken. But the broader DXY is, of course, euro led, and we have question marks there.
Anybody else last takers on the currency question before we shift gears? Let's keep moving. We can always feed this back into some other thoughts and discussions, especially as we get into more regional ideas. Let's look at asset class allocation. You know, one of the questions that's popped into the chat is, what do you think about the old perspective of 60-40 as an allocation that makes sense? How does that set with you as you're currently thinking about equity versus fixed income? And we will also get into the world of alternatives. Does the 60-40 still work, or do you have other thoughts? Who wants to jump in on this one? Maybe Stephan, Joe?
Yeah, sure. I can probably start. So we are neutral within our equity allocation. So as we still see that there are pockets of values in certain areas of the fixed income market, or at the very least that it has been, with equities being at valuation levels where they are, which are very lofty for the US and at least not cheap in Europe, at least not if you measure Europe against its own history. There's where we indeed see that there is a certain risk that there's probably a bit too much optimism baked into the market, and that there may indeed be the perspective of a setback, of a serious correction, not necessarily a bear market, but at least a serious correction. So that makes us a little bit cautious on the equity part. On the other hand, as I was saying, fixed income still should play a fair role. We have still okayish absolute level of rates. Sometimes risk spreads are a bit tight, no doubt about that. But generally speaking, there are still pockets of value. Also, when we look into emerging markets, for instance, also in local currencies, where some central bank rate cut potential should help the asset class and be a boost to performance, as well as it's a general expected dollar weakness, where we still think that the dollar has further room to weaken for several reasons. So therefore, being a bit more diversified kind of makes sense. And talking alternatives, and alternatives includes commodities for us. There we have precious metals, we have gold, we have silver, where we're still quite optimistic, and where we think that those assets can continue to provide value in a portfolio in those days.
Fair enough. Joe, how about yourself?
Yeah, thanks, Tim. So I mean, I tend to subscribe to the comments that have been made about the market being priced for almost a perfect picture, if not quite a perfect picture. So like you mentioned, we've had all of the tariffs and the policy uncertainty, and there's this metric, you might have it in your chart pack actually, Tim, the economic policy uncertainty measure. And that's skyrocketed. It's come back a little bit as policy easing is beginning to ease again. But VIX, credit spreads are on their absolute lows, multi-year lows. So I think this tells us that in context of everything that's been talked about, the big story in markets is how pricing has really moved on, and how we see this sort of perfect pricing situation really in key risk assets. So what do you do about that? Well, profits are okay, margins are expected to grow, rates are falling. You know, that it's not unreasonable that investors are thinking about the soft landing. And I get asked a lot about parallels between today and the mid-90s. That comes up an awful lot in conversations with investors. I've been writing about it a lot on LinkedIn and in our weekly notes. But I think there are safer ways to play the soft landing than playing it through the US. So we would focus more on the idea of broadening out. So looking at rest of the world markets to perform and benefit from those more favorable macro and profits dynamics. We would look at EMs and EFI for sure. But EMs has been a really interesting area in the context of the weaker dollar, in the context of stronger fundamentals, the fact that it's lower volatility actually now, surprising to many investors. So I think that's probably the way to think about equity allocation. And then I know you want to think about the 60-40 portfolio as well. But the challenge there is the extent to which core government bonds are the ultimate diversifier, as we've kind of gotten used to during the 2010s, or whether investors need to think a little bit more adventurously. Treasuries might be a safe haven, but not sure that they're the ultimate safe haven now, you know, which is something that many investors had gotten used to. Can bonds really rally very strongly in a recessionary scenario if we still see, you know, legacy inflation, if we still see investors requiring a positive term premium for all of the fiscal challenges? So I think looking outside of that 40 for your insurance safe part of your portfolio makes a lot of sense, which brings in some of the other areas of markets in alternative space, as you mentioned, hedge funds, maybe private credits, as another way to try and find portfolio resilience. Looking for bond substitutes has been a big part of how we've been trying to find that resilient portfolio shape, alongside looking at having risk allocation focused on emerging and frontier markets.
Oh, fair enough. Eric, I think you want to jump in here.
Yeah, I can add. I mean, I don't. Of course, valuation is important, but it's a poor timing tool. Looking at positioning, I mean, you can measure it in several different ways, but my take is that it isn't stretched yet. So I think that the pain trade still is up from here. And when it comes to positioning, since, you know, I see the Fed rate cuts at something like, you know, mid-season safety cuts or something, I don't see too much value in bonds as of now. And as others has touched upon, I think it makes sense to broaden out, but we do it, you know, step by step. And in this environment where we, you know, we're not out of the woods, but the risk for recession in the US and so forth is smaller. And I think it makes sense to diversify into small caps. And I would say that, you know, that is everywhere in the developed world, both in the US, but also here in Europe, since they are less affected by tariffs.
Oh, fair enough. Well, look, we'll continue this discussion. I do want to hit on a couple of comments about alternatives, and I'll show another picture or two that I think are worth bringing into the discussion. One is, as we talk about equity, fixed income, alternatives, some interesting data from Evenco, and this is European domiciled funds are essentially the data set that they're utilizing. But what it shows is in the left-hand panel, what was projected in September, in terms of where flows were going, and certainly there was a heavy dose towards fixed income and equity. Their projections into October and November is actually showing a more negative towards equities, and to a degree fixed income in terms of incremental flows from their work, which I think is quite interesting. I'll bring out a different point of reference on the alternative front. Work that we're doing in terms of assets under management continues to show, broadly speaking, that alternatives are expanding quite rapidly. We all know this, we hear about it. We hear an awful lot about private equity, private credit these days, but private equity continues to be the biggest category. And interestingly, from the standpoint of some longer term funds, retirement funds, etc., it's getting to be anywhere from 10 to 20% of allocations in terms of private market oriented assets. We just published a report last week, looking at some of the unintended consequences that we need to at least be careful about when it comes to transparency. So I've brought up a couple different elements here as it relates to asset flows, as it relates to movement in the world of alternatives. There was a question that came up in the chat room about disclosure as it relates to the private markets. How do you think about starting to shift gears, as some of you all have talked about with alternatives, keeping in mind some of those other considerations? Anybody want to jump in here? Sebastian, you may have thoughts as well, still further on the fixed income credit angle of things.
Well, on the alternative side of things, I would say that generally the size cannot totally decouple or outgrow public markets, because ultimately these assets need an exit. And as it stands today, it is already we had a tough environment for exits over the last 2-3 years, and so these projections in the end, I think, will clash unless private players will start selling each other the same assets, which is already something that we have seen quite frequently a couple of years ago. I am rather skeptical of the value creation you can obtain in diversifying, but ultimately you end up with something that is simply an illiquid asset. And these things historically demand a premium precisely because they are illiquid, whereas currently today, we probably are not witnessing this type of value. And I think this ultimately applies also to the private side of the credit, where there is not clearly a yield premium versus what you can obtain in public markets. Everything is quite compressed. The risk seems to be materially higher on the private side. And of course, things get refinanced internally. I mean, there are things where, the banking sector would simply be unable to behave like a private players because of rules and regulations, and it's been a bad idea. But I would simply say that there's never been a credit test to these assets, and the day there will be a credit test on these assets, it may be problematic because we have all been used to central banks intervening in case we had something nasty on the economy. In that case, it would be quite isolated in people's portfolios. So I would caution around diversifying and giving away the insurance. The insurance might be expensive today, but going back to our previous discussion, I would actually keep the 40%, which is rather small at a time where risk assets are stretched. The insurance, of course, is expensive. This is what happens normally. But ultimately, it's not about making money sometimes, but it's also about not losing it. And in that case, I think the insurance will pay out fairly well.
Fair enough. Maya?
Hi. Yes, I mean, I guess maybe just framing that where Sebastian left off, that 60-40 question. I mean, I think, a lot of what we've discussed in our session so far, I mean, sort of trade wars, sort of leading towards deglobalization from globalization, greater emphasis on fiscal policy, rising debt, and so on and so forth. Perhaps less independent monetary policy, something we touched on at the top of our session. Those are sort of 3 or 4 key factors that I would argue have driven that trend lower we've seen in bond yields over the last 35, 40 years. That have delivered, if you will, huge gains for us all, from combining risky equities on the one side with old school fixed income, by which I mean government bonds on the other. And while I'd agree with some of the comments made that it's not entirely behind us, I do think that some of the easy gains perhaps are, because when we take that bigger picture view, the forces that underpinned those easy gains for a 60-40 portfolio have shifted. I would say as well, though, particularly picking up on some of Sebastian's comments a moment ago, is I think it's precisely the differences that we see around volatility characteristics and indeed return characteristics that appeal to us when we're talking about combining private assets with public assets. You could extend that to gold as well, but we could talk about that separately. And I think I'd say two things on the private side. I'd say first that in many ways that steepening up that we've seen of government bond curves is quite nice for some private markets, like direct lending, for example, that have a large floating rate component. So the all-in yield, or the insurance, to use a word that was just used a moment ago, is actually pretty appealing for those markets. And again, you could extend that to investment grade public credit too, to be candid, because you've got the benefit of steeper curves, and you've got better credit quality. The second thing I'd say is that I think we can all agree that every risk has attached to it a price. And when we look at, we've talked about how fully valued some of the corners of public markets are, particularly U.S. equities, for example. But when we look at, say, something like EV to EBITDA, and then try and compare public markets with private markets, we do see a lot more caution baked into private markets at the moment. And that's perhaps one of the reasons why, when we look back over time, private markets do tend to decline less and recover faster during drawdowns, with a big caveat that manager selection is a really important differentiator when you move from public to private markets. So that would be what I throw into the mix in terms of possible sources of diversification.
No, that's great. And a couple of you all have already referenced different regional perspectives. I want to bring regional allocation more fully into the discussion. And again, I'll set this up with just a couple of quick pictures. Again, this data is from Avinco. It's their funds flow projections over time. And it is interesting. This is all funds and month by month where things have moved. And it is interesting to look at. There's been some positive element to the European flows relative to the US flow. If we dig a little bit deeper from an equity perspective, so this is looking, not total funds, but equity funds, there's a bit of a bulge back a few months ago, and it started to shift lower. Same thing with the US, which kind of goes back to that prior asset allocation chart that I was showing. Fixed income has been more skewed towards building in the US relative to Europe. So a couple of interesting dynamics from the standpoint of where do you put them? And most of this data was oriented towards US and Europe, with the European domiciled funds not having huge allocations in Asia. But I'd also bring up two last charts. One is just in equity returns. It has been exceptional, and it's easy to look at the Magnificent Seven specifically as driving the US market. But yeah, X the Mag 7, we're up 33% in the last year and 3 quarters. Europe isn't bad at 16%, and the world has certainly done fine. So with those in mind, big equity performance, some interesting interplay from the standpoint of regional flows. Where do you want to put your money looking ahead? Does US continue to be the market driver, or are we starting to see more movement abroad? Eric, do you want to jump in on this one?
Yeah, sure, I can start. Well, I think when looking at flows, we've seen continued inflows to European funds, even here in my home market, that is the Nordics, but it's been smaller and smaller for every month. And I think the thing is that the realization that we will see stimulus, investments in Germany, here in the Nordics, maybe some, Eastern European countries, but there's a lot of countries in Europe that has too much debt. I mean, just look at France, for instance. So that theme, has weakened for the last couple of months, and I guess we need to see some new catalysts for that to happen once again. So when we're looking at flows, we see that invest going back to basics. We see that investors are going back to a lot of global exposure. We're looking at the flows in this region of Europe. But I still see that, looking at the flows year to date, it's a huge shift compared to other other years, of course. But I think also, that it is what is new for a lot of investors is FX, right? We haven't had to hedge the US dollar. So I mean, just in my base here in Sweden, the dollar has depreciated 18% this year, and that is something new. So if you take that into consideration, investors are looking to diversify it outside of Europe because of FX reasons, I would say.
No, fair enough. Joe, you're shaking your head or nodding your head. Do you want to jump in here?
No, I was nodding. I don't
didn't
want to
mean-
have
I
I
didn't
don't want to
mean
have
this,
a
I meant
fight
this.
in polite company, Tim. No, I think the dollar is a good element to raise. I wonder how much of that flow into the US is going on currency hedge basis from European and other global investors now. That was like a forbidden topic for decades, right? Everybody was invested in the US currency unhedged because it was a return kicker and a risk mitigator. The dollar would rally in risk off, and most of the time it would go up anyway. So you had this double whammy. And that, as you say, that era of US exceptionalism, at least on the currency side. Equities, maybe we can have more of a debate. I'm quite persuaded by what you suggested, Tim. Outside of the Mag 7, there's still scope for the 493 to do a bit of catching up. There's still a broader story, maybe in some of the mid caps as well. Some of those left behind quality areas in the US market still look interesting. But we are seeing that US exceptionalism, dollar exceptionalism really being challenged by investors, and it's coming through on the currency side. So you come back to maybe a catch-up story, a convergence story in Europe. I mean, these days, the economists aren't talking about US exceptionalism, they're talking about Spanish exceptionalism, excepcionalismo español, right? The OECD reckons Spain is going to be the fastest growing Western economy in 2026 and in 2027. Remarkable. So that's really interesting to me because it kind of tells us that Europe doesn't really need good news. It just needs the absence of bad news in order to perform. And the challenge has been over recent years is while the US economy has had many elements of return boosting from positive news, from positive supply and demand shocks, Europe's had a sequence of bad luck. The manufacturing slowdown, the conflict in Ukraine, of course, the big challenge with inflation causing a logjam around credit supply to the economy. So maybe European economy, European markets can catch a little bit of a break. And if you look at some of the dynamics we see in Southern Europe, Portugal too, right? Greece and Italy as well, to a degree. There's some really impressive dynamism going on in those economies and in the equity markets as well. I mean, if you want proper growth, you have to go to emerging markets and Asia. But in a Western context, that's really quite an important trend to be focused on.
Yeah. Stephan, do you want to jump in here? While you're turning your mic on, I would say that at the Scottish St. Andrews Vinco Fund Forum last week, I was surprised at how many European bulls there were in the room when, raising a hand in terms of where people want to invest regional. And granted, this is a European base of investors, but there was definitely a home market interest. But Stephan, go ahead. Sorry.
Yes, absolutely. There is, and I fully agree with what Joe is saying in terms of flows into the US. The latest data that we saw is indeed that if European clients are nowadays looking into US equities, they may do so more on an FX hedged basis, which we also think makes some sense. Talking about Europe as a whole, our feeling is that after this initial massive phase of, say, optimism and relief that eventually Europe starts to pull its stuff together, I wouldn't really call it bad luck, but probably bad management when I look at the economic performance of Europe over the last couple of years. So it's not that it happened totally out of nowhere, and you couldn't have done things to mitigate the impact. But nevertheless, they put those numbers forward and the market was reacting to this. And my feeling is that now we are in the sort of proof of progress phase where the market says, okay, we gave you a little bit of upside credit, and now we want to see how things are evolving, how things are moving. This is a little bit like US equities did, or US infrastructure related equities did in 2021 when the IIJA was introduced in the US. There we had a little bit of the same. Having said that, and this also captures earnings, my feeling is that we are still more in a stock pickers market. When you look at Europe, when you look at European earnings expectations, and you split them in companies which having the majority of their earnings or revenues in euro or non-US domestic areas of the world, and those who heavily US exposed, you see a huge divergence in terms of performance, in terms of earnings expectations, with those domestically geared faring much better than those foreign geared companies. And the same is true in the US. You have that on your chart with the Mac 7 again leading the pack. Looking at 3 months realized correlation on the S&P, it just recently hit almost a 5-year low. So there's close to zero correlation within the S&P, which means that there are a few stocks moving in the one hand and a lot of others moving in the other hand. So our feeling indeed is that probably the thing that investors need to get right nowadays is probably not that much the region, but the topics. You need to be exposed in the right places of the market, and then you may even be forgiven if you're not had enough exposure overall. But if you catch those trains, you should be good. I mean, European financials is probably a prime example, talking about a very high performance sector that indeed behaved very, very well, as Sebastiano was saying at the beginning of this conversation.
So I am rather surprised it's almost an hour into this discussion. I think we could keep going for a while because we barely scratched the surface, but I am cognizant of time. I'd like to go around the circle. There's been 2 questions that have come in that essentially were hitting on the same thing. In a relatively brief perspective, if you had new capital to put to work tomorrow, that could be targeted as opposed to broadly distributed around your portfolios or perspectives, what one place would you look to put capital if you could tomorrow? Who wants to start this off?
I'm happy to start. One of the things we haven't talked about on our call is Japanese equities. I think they look really quite interesting. I guess two things that I'd point out. Unlike Europe that we've been discussing, has sort of disappointed a little bit. Japan is earning really well, is expected to continue earning well, and is delivering to those numbers. There's a very strong bottom-up story as well. And valuations, the second thing we've been talking about, are really cheap however you cut it. So Japanese equities would be where I'd invest tomorrow.
There you are. Who wants to go next?
Well, let me do it short. I would buy precious metals miners. So
Precious metal miners, as
miners,
opposed to the
so
metal
right.
themselves.
Exactly, due to the operating leverage. I mean, we're at levels where the guys are earning insane amount of money, insane margins, and as we expect precious metals to go up, I mean, you still should have that gearing to a certain extent. So we expect those pocket of the market to continue to do well.
Fair enough. Sebastiano, how about you?
Yeah, well, this is a tough question. Today, I think European small caps, I want to be a believer. And so if the numbers do come through, after the multiple expansion, there is actually a decent amount of inflection and operating leverage in the businesses. So provided that the fiscal plans turn real, then we will see quite a bit of an inflection. It's true that we have anticipated some of it, but we have seen nothing in the numbers. And I think there's truly a lot of upside there.
Oh, fair enough. Joe?
Yeah, I would. I'd be emerging markets focused, Tim, global South, as we should sort of say, maybe these days as well. I think you've got a few options. I mean, India equity is very unloved at the moment. The rupee has been depreciating, despite the fact that other EM currencies have been appreciating versus the dollar. It looks interesting. Growth at a reasonable price. Few sort of hiccups with the recent news flow, but I'm not sure it derails the structural story there. Emerging market fixed income opportunities look really interesting as well. So we've had emerging central banks cutting rates. They've had a much better post-pandemic inflation control track record. You've not got the sort of stagflation stories in much of Asia, for example, like you have in the US and the UK. Still high real yields. The currencies are very cheap, can continue to appreciate. And one thing we found is actually, if you look at the rolling volatility of EM bond markets and compare them to DM bond markets, of course, what you expect to find is that when you include the currency volatility, they're a lot more risky. It's not true. EM volatility in fixed income is lower than global bond volatility, even including the currency. So in this new environment, new paradigm, supply shocks are there, inflation risk is a live thing in the West. Actually, our sense of where the safe haven assets might be maybe needs to sort of pivot a little bit more toward EM and Asia at this point. We think that's a really interesting area.
No, fair enough. And Eric?
Well, I would agree, about the broadening out theme. I agree on European small caps. I found a lot of value in lagging sectors such as listed real estate. And also when it comes to private markets, looking into private equity small caps, the really small ones, been really lagging and is exceptionally cheap compared to a lot of other investments. So those would be my top three.
No, fair enough. Well, look, like I said, we could keep going here, but it is now after 3 p.m. London time. And so why don't we bring things to a close? Couple of closing remarks. Most importantly, thank you all for joining and being willing to be a panelist in today's discussion. Secondly, we're happy to share the slide deck if anybody wants the reference points that were brought up. And thirdly, thank you for Venko for setting up the call. This has been fantastic. Appreciate the listeners ringing in and those who will be listening to a replay. Plenty to chew on and lots more that we could discuss. So thank you, everyone, and we'll bring the call to a close.